The U.S. economy slowed significantly
Yes,
last year, with real
yes.
GDP rising at
Thank
a
you.
below trend pace of 0.9%. Consumer spending appears to have picked up this quarter, although some of that strength may reflect the effects of swings in the weather across the turn of the year. In contrast, activity in the housing sector remains weak, largely reflecting higher mortgage rates.
Yeah.
Higher interest rates and slower output growth also appear to be weighing on business fixed investment. Committee participants generally expect subdued growth to continue. As shown in our summary of economic projections, the median projection for real GDP growth stands at just 0.4% this year and 1.2% next
Look
year.
at that. It's like they're expecting
well
a
below the
bounce of some
median
sort.
estimate of the longer run normal growth rate.
Huh.
And nearly all participants see the risks to GDP growth as weighted to the downside. Yet the labor market remains extremely tight. Job gains have picked up in recent months, with employment
GDP
rising
growth
by an
is
average of
weighted to the downside. Wow.
351,000 jobs per month over the last 3 months. The unemployment rate remained low in February at 3.6%. The labor force participation rate has edged up in recent months, and wage growth has shown some signs of easing. However, with job vacancies still very high, labor demand substantially exceeds the supply of available workers. FOMC participants expect supply and demand conditions in the labor market to come into better balance over time,
That means
easing
more
upward
employment.
pressures on wages and prices.
Yeah, better balance means
The
more
median
employment.
unemployment rate projection in the SEP rises to 4.5% at the end of this year and 4.6% at the end of next year.
Ooh.
Inflation remains well above our longer run goal of 2%. Over the 12 months ending in January, total PCE prices rose 5.4%, excluding the volatile food and energy categories.
Wow, that's crazy.
Core
Excluding
PC
those things,
excluding,
that's still really
excluding
high.
those, core PCE prices rose 4.7%.
Oh, okay.
In February, the 12-month change in the CPI came in at 6%, and the change in the core CPI was 5.5%.
Wow.
Inflation has moderated somewhat since the middle of last year, but the strength of these recent readings indicates that inflation pressures continue to run high. The median projection in the SEP for total PCE inflation
look at that.
is
They're not expecting to get to
3.3% for this
2%
year,
until 2025.
2.5% next year, and 2.1% in 2025. The process of getting inflation back down to 2% has a long way to go
Wow.
and is likely to be bumpy.
Oh, wow.
Despite elevated inflation, longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation.
Yeah.
We are highly
Which
attentive
they
to the risks that
ironically
high
extract
inflation
from their
poses to
measurements
both sides
to
of
make
our
a
mandate,
core number, right?
and we are strongly committed to returning inflation to our 2% objective. At today's meeting, the committee raised the target range for the federal funds rate by a quarter percentage point, bringing the target range to 4.75% to 5%. And we are continuing the process of significantly reducing our securities holdings. Since our previous FOMC meeting,
So
economic
right off the balance
indicators have
sheet.
generally come in stronger than expected, demonstrating greater momentum in economic activity and inflation. We believe, however, that events in the banking system over the past 2 weeks are likely to result in tighter credit conditions for households and businesses, which would in turn affect economic outcomes. It is too soon to determine the extent of these effects, and therefore too soon to tell how monetary policy should respond. As a result, we no longer state that we anticipate that ongoing rate increases will be appropriate to quell inflation. Instead, we now anticipate that some additional policy firming may be appropriate.
So not
We will
rate
closely
increases?
monitor incoming data and carefully assess the actual and expected effects of tighter credit conditions on economic activity, the labor market, and inflation. And our policy decisions will reflect that assessment.
Interesting.
In our SEP, each FOMC participant wrote down an appropriate path for the federal funds rate based on what that participant judges to be the most likely scenario going forward. If the economy evolves as projected, the median participant projects that the appropriate level of the federal funds rate will be 5.1% at the end of this year,
Wow.
4.3% at the end of 2024, and 3.1% at the end of 2025.
Okay, so they are signaling
These
cuts,
are little
but they're just
changed
not on the
from our
horizon
December
right now.
projections, reflecting offsetting factors.
That's going to go ahead and
These projections are not a
make,
committee decision or
rallies
plan.
happen
If the
for
economy does
indices
not
that actually
evolve as
might-
projected, the path for policy will
that's going to be
adjust
good
as
for gold too,
appropriate
actually, because the
to
sustained,
foster our maximum employment and
sustained
price
increases
stability
are going to
goals.
keep going for a while.
We will
That's gonna
continue to make our meeting
that's gonna make
decisions
gold
meeting
have
by
value.
meeting based on the totality of the incoming data and their implications for the outlook for economic activity and
Wow,
inflation.
gold is racing right now. If you're
We
watching
remain
it,
committed to bringing inflation back down to our 2% goal
Wow.
and to keep longer-term inflation expectations well anchored.
yeah,
Reducing inflation is likely to require a period of below-trend growth and some softening in labor market conditions. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the longer run. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we
oops. Back, come on, Jerome,
do
let's go.
is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
Wow.
Thank you, Colby Smith with the Financial Times. How confident is the committee that the recent stress that we've seen and you've alluded to is contained at this point, and that deposit flight among mid-sized lenders in particular has ceased?
Thanks. So I guess our view is that the banking system is sound and it's resilient. It's got strong capital and liquidity. We took powerful actions with Treasury and the FDIC, which demonstrate that all depositor
hold on.
savings are safe.
Hold on a second. Hold on. It's as strong and resilient because they could backstop it with the FDIC emergency fund, or is he actually saying he thinks they're all solvent? Because last I heard, they were like flying people around the country looking at other banks this weekend, namely Warren Buffett. So that's interesting. I want to see what Maury has to say about that.
And that the banking system is safe. Deposit flows in the banking system have stabilized over the last week. And the last thing I'll say is that we're undertaking a thorough internal review that will identify where we can strengthen supervision and regulation.
Okay, just a quick follow-up. I mean, given all of
That's good, because one of the articles I heard was that SVB actually was under regulatory oversight for the months that they didn't have like a risk supervisor. I don't know if it was directly because of that or something else, but that is something that they like admitted after the fact that everything happened and they had to like bail them out or backstop them. That they were like, oh yeah, by the way, we've been watching this bank for about a year. Like, okay, so that means here's what it tells me. That means there's still more banks that are watching right now, and he has to have veiled public comment because he can't out who they are. Otherwise, it will cause the thing they're trying to help avoid.
the stress and the uncertainty that you've also alluded to in the statement, how seriously was a pause considered for this meeting?
So we considered, we
not a
did
good
consider
question.
that in the days running up to the meeting, and you see the decision that we made, which I'll say a couple things about. First, it was supported by a very strong consensus, and I'll be happy to explain why. And really it is that the intermeeting data on inflation and the labor market came in stronger than expected, and really before the recent events, we were clearly on track to continue with ongoing rate hikes. In fact, as of a couple of weeks ago, it looked like we'd need to raise rates over the course of the year, more than we'd expected at the time of the SCP in December, the time of the December meeting. We are committed to restoring price stability, and all of the evidence says that the public has confidence that we will do so, that will bring inflation down to 2% over time. It is important that we sustain that confidence with our actions as well as our words. So we also assess, as I mentioned, that the events of the last 2 weeks are likely to result in some tightening of credit conditions for households and businesses, and thereby weigh on demand, on the labor market,
That's that domino
and
effect.
on inflation.
Yeah.
Such a tightening in financial
but again,
conditions
here's
would-
the thing. Like we've been talking about this a lot when I do Monday Mortgage Minute or our podcast here. We've been talking about this where like they can say those things and they have to have more tightening, but sometimes that tightening is taking 6 months, 8 months, 9 to 10 months to actually make its impact in the actual economy versus just making the policy decision and it happening tomorrow. It doesn't work that way. So if he's still saying that right now, obviously, clearly we're still going to go through this for the rest of this year, but like their plot chart was showing too, that means they're not even going to consider looking at rate cuts until 2024.
would work in the same direction as rate tightening. In principle, as a matter of fact, you can think of it as being the equivalent of a rate hike, or perhaps more than that. Of course, it's not possible to make that assessment today with any precision whatsoever. So our decision was to move ahead with a 25 basis point hike,
Right.
And to change our guidance, as I mentioned, from ongoing hikes to...
Which is interesting, because if he's saying they're going to
some-
change
some
monetary
additional
policy,
hikes may be-
if
some
monetary policy
policy firming may
changes,
be
that means that
appropriate.
rates aren't going to be the
So
switch. They're
going
going to have to do
forward,
something else.
as I mentioned, in assessing the need for further hikes, we'll be focused, as always, on the incoming data and the evolving outlook, and in particular on our assessment of the actual and expected effects of credit tightening.
Steve Leisman, yeah.
Mr. Chairman, can you explain the difference between ongoing rate increases and firming? Does firming imply a rate increase per
Equities
se,
are
or could
soaring right now.
policy firm without you
S&P
increasing rates?
The 30-year or the Dow.
No, I think it's meant to refer to our policy rate. Really, I would focus on the words may and some, as opposed to ongoing. So we clearly were, what we were doing there was taking on board trying to reflect the uncertainty about what will happen. I mean, it's possible that this will turn out to have very modest effects. These events will turn out to be very, very modest effects on the economy, in which case, and inflation will continue to be strong, in which case, the path might look different. It's also possible that this potential tightening will contribute significant tightening in credit conditions over time, and in principle, if that means that monetary policy may have less work to do. We simply don't know. So,
Do you have concerns that the hike you did today could further exacerbate the problem in the banks?
Yeah, he said that.
no, I mean, with our monetary
he
policy,
basically said
we're
that.
really focused
You're saying
on
that's going to create
macroeconomic outcomes.
He basically just said that's going to create tightening credit conditions for consumers and for the business sector. So banks are businesses and they lend to businesses. So it will, even though he's about to say it won't. Watch.
In particular, we're focused on this potential credit tightening and what can that produce in the way of tighter credit conditions. I think when we think about the situation in the banks, we're focused on our financial stability tools, in particular our lending facilities, the discount window, and also the new facility.
Nick?
Nick Timmeros of the Wall Street Journal. Chair Powell, in your testimony 2 weeks ago, you had indicated you thought the terminal rate would be higher. Obviously, that was before the stress in the banking sector. And I realize there's a lot of uncertainty, but can you explain at all to what extent your forecasts or those of your colleagues or those of the board staff incorporated today a material tightening of credit availability because of the stress in the banking sector, or are you waiting to see it in the data before you incorporate that potential tightening
That's a
into
good
your
question.
forecasts?
That's a good question,
So,
because the answer should be both. I think the answer should be both. He's got to do both. He's got to look at the outcome, but also he has to look at whatever the bank stresses that are happening and the duress that they're under, and figure out what other kind of situations they need to help solve or fix for people that the public just doesn't know about. I hope the answer is both. Let's see.
We've just come from an FOMC meeting, and the people who write the minutes will be very carefully counting. But I'll tell you what I heard. What I heard was a significant number of people saying that they anticipated there would be some tightening of credit conditions, and that would really have the same effects as our policies do, and that therefore they were including that in their assessment, and that if that did turn out not to be the case, that in principle you'd need more rate hikes. So some people did reflect that in their SEP forecasts. I think there may also just have been. Remember, this is 12 days ago.
Yeah,
We're trying to
I
assess
was talking
something
about
that
the
just
bank
is so
situation, too.
recent. And it's people, it's very difficult. There's so much uncertainty. So
But again,
December was.
Okay, so if you look at the SVB thing, it actually has a direct correlation to the Fed raising rates because of all the treasuries that they were holding. So that inverse correlation of the treasuries losing value as the Fed's raising rates is partly what caused it. So now that he's citing it that, we only knew 12 days ago, like they have to know that SVB isn't the only people holding these treasuries, that they are basically discounting the value of every single time they do a rate hike. That's not like a foreign thing. They should know this. I bet they do know this. They just have to answer it this way.
Was a good place to start, and we wound up with very similar outcomes for December. And in a way, the data in the first part, the first 5 weeks of the intermeeting period, pointed to stronger inflation and stronger labor market, so that pointed to higher rates. And then
Right.
this latter part, kind of the possibility of credit conditions tightening, really offset that effectively.
To follow up, have you considered at all whether your primary tool, the funds rate, is going to be enough to sustain the kind of tighter financial conditions that you
It
believe will
won't
be
be.
necessary?
It won't be. That's why he talked about monetary policy and having to do other things. And he didn't mention what it was, but he was just saying that they have to. It's even in the notes. You see the strike through and the red notes that they post. It's on the other page. I'll show you in a minute. But yeah, this is where they're going to have to effectively do some other type of process or come up with some other tool or resource to achieve their goal, because the rate isn't doing it.
Necessary without doing significant damage to the banking sector? Have you, for example, considered changing reserve requirements, selling assets out of the system, open market account, as a way to better achieve tighter financial conditions that don't accelerate deposit erosion, for example, from banks?
You know, we know that we have other tools in effect, but no, we think our monetary policy tool works, and we think, you know, many banks, our rate hikes were well telegraphed to the market, and many banks have managed to handle them.
Victoria. Hi, Victoria Guida with Politico. I wanted to ask, you, along with the FDIC and the Treasury, the Fed Board decided to invoke the systemic risk exception to allow uninsured depositors to be protected at these two banks. And I was just wondering if you could speak to why that decision was made. Was it purely a confidence issue, or was there a concern that there would be some sort of economic contagion or financial contagion from the failure of these banks?
All the above.
The issue was really not about those specific banks, but about the risk of a contagion to other banks and to the financial markets more broadly. That was the issue.
Okay, and then can you also
hold on. But they're not the only bank that would be the issue for. So if that's the function or the variables in the formula that they came to that conclusion for, SVB was the 16th largest bank, which means there's 15 larger than it that might also still qualify for that same exception, or any of the ones from number 17 through 100 that are also still big enough for them to make that same decision. Very interesting.
Can you speak to the role that you will be playing in the Fed's internal investigation on its supervision and regulation?
Lead quarterback?
Vice Chair Barr is of course leading that review, and he's responsible for it in his capacity as Vice Chair for Supervision. I realized right away that there was going to be a need for a review. I mean, the question we were all asking ourselves over that first weekend was, how did this happen? And what we did was...
I'm so sorry for pausing again. How is it they were asking themselves how this happened if they were already overseeing SVB Bank privately and they didn't let that know to the public until after this happened? I don't understand that. And also, how can they play dumb if they know that the impact of raising the federal funds rate directly correlates to a negative side on the value of the U.S. Treasuries? This is so crazy to hear this. This is nuts.
Early Monday morning, we sat down and said, let's do this. And he was obviously going to lead it in his capacity. So I don't, my role was to announce it, and I get briefed on it, but I'm not involved in the work of it.
Hi, Chair Powell. Howard Schneider from Reuters. So I want to go back to your February press conference. You mentioned the word disinflation, I believe, 9 or 10 times, a process that you felt was...
Equities are all over the place, you guys.
I forget the word you used, but gratefully underway or something like that. Is disinflation still occurring in the U.S. today?
Yes. I mean, what actually happened, Howard, was I got the question 12 times.
Great question.
Maybe it's a feature, not a bug. But yeah, absolutely the same. The story is intact. So it's really three parts, right? Goods inflation's been coming down now for 6 months. It's proceeding more slowly than we would have liked, but it's certainly proceeding. Housing services is really a matter of time passing. We continue to see the new leases being signed at much lower levels of inflation. So that's 44% of the core PCE
Still talking about housing,
index, where you've got a story that's ongoing.
Where there was the greatest easing
where we didn't have
that he
in February and we
mentioned last
still don't have now is a sign of progress in the non-housing services sector.
Right, not enough
and that
disinflation.
is that's just something that will have to come through softening demand and perhaps some softening in labor
Demand
market
destruction.
conditions. We don't see that yet,
Demand
and that's of course 56% of the index. So the story is pretty much the same. I will say that the inflation data that we got, to your point, really pointed to stronger inflation.
If
Wow.
I could follow up on that,
Big
I was
reversal
curious
on
why
equities
you don't
right
see
now
more
as we
coming
come
from
into
the
the
credit
hourly
crunch,
close
because it
in a
seems to
couple
me that's
minutes.
something that you'd actually.
As we're coming into the hourly close, there's a big reversal on the 15-minute candle for the Dow. I haven't flipped back over to the S&P yet, but on the Dow, the 30-minute hit some daily highs and then whip right back down. And on the 15, it is now trending bearish or looking to break new lows. Oh, there it goes. Wow. Okay, let's keep listening.
Welcome to a degree and expect. And are you not seeing more coming from that because you don't know, or because you just don't want to have another round of wishful thinking?
So it's really just a question of not knowing at this point. There's a great deal of literature on the connection between tighter credit conditions, economic activity, hiring, and inflation. Very large body of literature. The question is, how significant will this credit tightening be, and how sustained will it be? That's the issue, and we don't really see it yet. It's so people are making estimates.
Yeah,
people are
he's saying
publishing
they don't
estimates,
see it yet.
But it's very
Again,
kind of
after a
rule
year
of
of
thumb,
tightening, they're still not
guesswork
seeing
almost
it?
at this point. But we think it's potentially quite real, and that argues for being alert as we go forward, as we think about further rate hikes. For us, we'll be paying attention to the actual and expected effects from that.
Man,
Hi, Chair Powell. Gina Smiley from the New York Times. Thank you for taking our questions. I wonder if you could talk a little bit, I know that you've got your internal review coming, but I wonder if you could talk a little bit about what you think happened with oversight at Silicon Valley Bank and whether this suggests that something about regulation and supervision needs to actually change going forward. And I wonder, how can the American people have confidence
we're
that there
8 months
aren't other
behind.
weaknesses out there in the banking system, given that this one got missed, as you
great
noted?
question. Great question.
So let me say what I think happened, and then I'll come to the questions around supervision. So at a basic level, Silicon Valley Bank management failed badly. They grew the bank very quickly. They exposed the bank to significant liquidity risk and interest rate risk, didn't hedge that risk. We now know that supervisors saw these risks and intervened. We know that the public saw all this. We know that SVB experienced an unprecedentedly rapid and massive bank run. So this is a very
$42
large
billion
group of
in
connected
24 hours?
depositors,
Yeah, it's
concentrated
pretty
group
big.
of connected depositors, and a very, very fast run, faster than the historical record would suggest. So for us, for our part, we're doing a review of supervision and regulation. My only interest is that we identify what went wrong here. How did this happen is the question. What went
oh my
wrong?
God.
Try to find that.
What
We
do
will
you
find
talk-
that.
what do
and
you
then make an
mean?
assessment of what are the right policies to put in place so that it doesn't happen again, and then implement those policies. It would be inappropriate
market
for me
risk
at this
position
stage
was
to
open for
offer
8
my
months.
views on what the answers
The market risk supervisor position, I don't know if that's what it's called, it was open for like 8 months. That's number one. We talked about this in the podcast the other day where I was telling the guys, like, hey, listen, even if you're an administrator at that company or you're a CEO or you're a C-level executive or a manager of any other department and you go, hold on, we have this massive big hole in our company. As a leader, you go, we need to fix this and figure that out. And again, they're in banking. They know what the impact of Fed rate hikes is, especially when you're holding treasuries and especially when the Fed is tightening up rather than loosening monetary policy. This is insane to hear him say this.
might be. I simply can't do that. Vice Chair Barr is leading this, and I think he's testifying next week. So, but that will be up to him. So that's really where it is. The review is going to be thorough and transparent. It is clear to your last question. It's clear that we do need to strengthen supervision and regulation. And I assume that there will be recommendations coming out of the report, and I plan on supporting them and supporting their implementation.
Sorry, and the final point, can we feel confident that these weanesses don't exist elsewhere, given that
No,
got missed
they
at this
do.
bank?
They exist elsewhere.
These are not weaknesses that are at all broadly through the banking system.
Hold on, that's not true. First of all, SVB just had a disproportionate amount of treasuries that happened that was part of the problem. The next, I think it was like 56% of their exposure was because of treasuries. Like the next one down the ladder, the next rung down the ladder, someone's holding like 42% or something. So this is not true. Here we go.
This was a bank that was an outlier in terms of both its percentage of uninsured deposits and in terms of its holdings of duration risk. And again, supervisors did get in there, and they were, as you know,
they're an
actually,
outlier, but they're not the only one. See how he's not answering
they
that
were on this
question?
issue, but nonetheless, this still happened, and so that's really the nature of the review.
Dang.
Is to discover that.
Michael McKee from Bloomberg Radio and Television. You've been very consistent in saying that the Fed would be raising interest rates and then holding them there for quite some time. Following today's decision, the markets have now priced in one more increase in May, and then every meeting the rest of this year, they're pricing in rate cuts.
No rate
Are they
cuts. His
getting
dot
this
plot chart
totally
just showed
wrong
that.
from the Fed, or is there something different about the way you're looking at it, given that you're now thinking that moves might be appropriate as opposed to ongoing?
So we published an SEP today, as you will have seen, and it shows that basically participants expect relatively slow growth, a gradual rebalancing of supply and demand in the labor market, with inflation moving down gradually.
Yeah, it's just repeating his notes.
In that most likely case, if that happens, participants don't see rate cuts this year. They just don't. I would just say, as
no rate
always, the
cuts
path
this
of the
year.
economy is uncertain, and policy is going to reflect what actually happens rather than what we write down in the SEP. But
Yep.
that's not our baseline expectation.
Yep.
Well, if I could follow up and ask, as
Maybe
you
he missed
look
the
forward
chart.
into the rest of the year here, are you saying that what you see and the 5.1% basically consensus is based on it will be sufficiently restrictive, or is it leavened by the idea of you don't know what's going to happen? In other words, what should people think about in terms of how the Fed thinks about how far it is from the terminal?
It's going to depend. Remember, we're looking, for purposes of our monetary policy tool, we're looking at what's happening among the banks.
They need to see two things happen. Number one, they need to see the banks not have any more problems, which they will. There's a couple that are still going to have issues. Number one. And number two, they need to see the impact of their interest rate hikes actually take impact and start driving the inflation numbers lower. Remember, every time that we talk about this, any inflation number that has a plus sign in front of it means it's still going up. If it's a zero, it's neutral. If it's negative, then it's disinflation. So just because maybe it's a 0.4 print month over month or a 0.2 print, you go, oh, it's slowing down. That's still in positive territory. It needs to go to negative territory in order for us to know that it's actually taking impact in the market and that the terminal rate may already be being flirted with and possibly even being met.
And asking, is there going to be some tightening of credit conditions? And then we're thinking about that as effectively doing the same thing that rate hikes do. So in a way, that substitutes for rate hikes. So the key is we have to have policies got to be tight enough to bring inflation down to 2% over time. It doesn't all have to come from rate hikes. It can come from from
reference to other
tighter
tools.
credit conditions.
Yeah,
so
other
that we're
tools,
looking
okay.
at, and it's highly uncertain how long the situation will be sustained or how significant any of those effects would be. So we're just going to have to watch. In the meantime, and obviously at the end of the day, we will do enough to bring inflation down to 2%. No one should doubt that.
Maximum pain. He used to say
Hi, Chair
some
Powell.
pain.
Rachel
Now he's
Siegel from
saying
the Washington
maximum
Post.
pain.
Thank you for taking our questions. I know we've talked a bit about how Silicon Valley Bank was unique to a certain sector of the economy, but there's also growing concern that there are financial stability risks from the commercial real estate market and loans that will begin to roll over later this year and next.
Oh,
And that
not enough people are talking about this. This is starting to come up on some other channels that talk about economics, especially commercial real estate. There are a ton of vacancies right now, and there's about to be more as companies look to trim their P&Ls. And you see a lot of companies, they're ditching employees, getting rid of people by the tens, hundreds, and thousands, depending on how big the company is. This is actually going to be another issue because the new question is who's going to occupy that space? Because you also have a functional problem of people becoming comfortable working remotely and some jobs not even requiring you to be on site to do the job that you're hired to do. Let's see what happens here.
regional banks also disproportionately hold those loans. Is there a risk that could mimic the kind of what we saw with SVB to banks that disproportionately are focused in commercial real estate?
Yes.
So, we're well aware of the
Say
concentrations
yes.
people have
The
in
answer
commercial
is
real
yes,
estate.
Jerome.
I really don't think
Yes.
it's comparable to this. The banking system is strong, it is sound, it is resilient, it's well capitalized, and I really don't see that as at all analogous to this.
Another question, would you
That
be
is
open
interesting
to
because, in my own personal opinion here, I think that the commercial threat is actually only 2 steps away from the policy decisions they're making. If policy decisions they're making, and they're saying this, not me, they're saying they need to see softening in the labor market, which means more employment. If you need more unemployment, that means because companies can't keep those people on. If you don't have people in your office or on your P&L, and especially if you have office space, then that means you also don't need that office space. That's only 2 steps removed, not 5 or 6 like he might be trying to imply.
independent investigation separate from the Fed's probe?
I welcome. It's 100% certainty that there will be independent investigations and outside investigations and all that. So we welcome, when a bank fails, there are investigations, and of course, we welcome that.
Thank you, Mr. Chairman. Edward Lawrence from Fox Business. Inflation has been rather sticky, so do you need help from the fiscal side to get inflation down faster?
Yes.
We don't assume that.
Less
We don't give
spending.
advice to the fiscal authorities, and we assume that we take fiscal policy as it comes to our front door, stick it in our model along with a million other things, and
The funny thing is, just a couple minutes ago, he was talking about demand destruction and we need to soften demand. But now he's trying to say that, like, you can have the same amount of dollars chasing the stuff and we're still going to accomplish the same inflation goal. That doesn't even make sense.
we have responsibility for price stability. The Federal Reserve has responsibility for that, and nothing's going to change that. So we will get inflation down to 2% in time.
And
By
if I can follow on
2025.
that, but they're working, the spending that's happened is working against what you were doing, right? So
Yes.
it's prolonging
Yes.
inflation?
Correct.
If you have to look at
Correct.
at the impulse from spending, because spending was, of course, tremendously high during the pandemic, and then as the pandemic programs rolled off, spending actually came down. So the sort of fiscal impulse is actually not what's driving it.
Here's what's really bad about this is it was like just January that they were talking about how there was like 2.9% GDP reading, but only like 0.2% of that was due to the consumer, and the rest of that GDP reading had to do with government spending and inventory replenishment. So the answer he's trying to give without anyone trying to remember that information is actually pretty hilarious. I mean, he's giving the right answer he's supposed to be giving in this context, but it's actually not backed by the information that they published.
Inflation right now. It was at the beginning perhaps part of what was driving inflation, but that's not really the story now.
Let's go to Neil Irwin.
It was in January.
Hi, Chair Powell. Neil Irwin with Axios. Two questions about aspects of the government's response on Silicon Valley Bank 2 weekends ago. First, why is this new bank funding facility done under emergency 13.3 authority as opposed to expansion of the discount window, changing the terms of the discount window that's been around a long time? And second, can you discuss the Fed's role in the FDIC guarantee of uninsured depositors and why there's $143 billion on your balance sheet last week supporting that deposit guarantee?
Sure. So 13.3 seemed like the right, we have a little more flexibility under Section 13.3. We've done quite a lot under the discount window as well. We needed to do a special facility that was designed a certain way, so we did it under 13.3.
Wow, big reversal in
really
equities,
no magic
everybody.
to that. It's only available in unusual and exigent circumstances, and it has to be meet certain requirements,
S&P,
but
NASDAQ,
it seemed to be
all
the right
tanking.
place. So with the FDIC, we're lending to the, in effect, we're lending to the bridge bank. So that's where the funds came from, and it's a loan that's 100% guaranteed by the FDIC, so there's no risk in it for us.
Wow.
Thank you. Chris Rugaber at Associated Press. The SEP suggests one more rate hike, as does the change in the language in the statement, in which suggests that you're perhaps nearing the end of a cycle of rate hikes. Do you feel, though, that if inflation remains high, you'll be able to resume additional hikes as needed, or have you somewhat tied your hands here with these signals about rate hikes coming to an end?
No, absolutely not. No, if we need to raise rates higher, we will.
Yep.
I think for now, though, we as I've mentioned, we see the likelihood of credit tightening. We know that can have an effect on the macroeconomy, on demand, on labor market, on inflation, and we're going to be watching to see what that is. And we'll also be watching what's happening with inflation and in the labor market. So we'll be watching all those things, and of course we will eventually get to tight enough policy to bring inflation down to 2%. We'll find ourselves at that place.
Hi, Chair Powell. Thanks for taking the question. Kyle Campbell with American Banker. I have a couple questions about the balance sheet. First of all, I'm curious at what point the financial supports that the Fed is extending through the discount window and through its enhanced lending facility might be at odds with the objective of reducing the balance sheet. And I'm also curious what your thoughts are on the...
What a good question, because not only is it at odds of that, but it's also considered quantitative easing, which is the opposite of tightening, which is tightening they're relying on in order to bring inflation down to 2%. These are force functions that are at opposites and odds with one another.
Not just the availability of reserves, but the distribution of them throughout the banking system, and at what point you might be concerned about it being scarce for certain banks.
So, so people think of QE and QT in different ways, so let me be clear about how I'm thinking about these recent developments. So the recent liquidity provision that has increased the size of our balance sheet, but the intent and the effects of it are very different from when we expand our balance sheet through purchases of longer-term securities. Large-scale purchases of long-term securities are really meant to alter the stance of policy by pushing up the price and down the rates, longer-term rates, which supports demand through channels we understand fairly well. The balance sheet expansion is really temporary lending to banks to meet those special liquidity demands created by the recent tensions. It's not intended to directly alter the stance of monetary policy. We do believe that it's working. It's having its intended effect of bolstering confidence in the banking system and thereby forestalling what might otherwise have been an abrupt and outsized tightening in financial conditions. So that's working. In terms of the distribution of reserves, we don't see ourselves as running into reserve shortages. We think that our program of allowing our balance sheet to run off predictably and passively is working. And of course, we're always prepared to change that if that changes, but we don't see any evidence that that's changed.
Wow.
Hi, Chair. Katerina Saraiva with Bloomberg News. The minutes of the January-February meeting, the last meeting, indicate that you discussed the possibility of runs on non-bank financial institutions and the impact of large unrealized losses on bank portfolios. Can you talk a little bit more about that discussion, kind of what was talked about in light of that? And then why didn't the Fed, do anything
That's a really good question, because this whole idea of unrealized bank losses is actually something that most people aren't looking at and have their eye on. But the actual chart shows that it is in the hundreds of billions of dollars, number one. And because they're called unrealized losses, they actually don't translate onto paper losses. So the banks are looking like they're actually more healthy than they actually are, because you don't have to count these particular losses on whether or not you're making money or losing money in the end. That was a rule change that happened and allows this to kind of go under the radar, but they are actual losses in the end when they have to be redeemed.
Anything about that at that point to ultimately prevent, what happened this month?
I mean, to be honest, I don't recall the specifics of that. It's been quite an interesting 7 weeks, but I will tell you though that we have.
You see her face; she's like, "Yeah, you're telling me." No kidding.
There have been presentations about interest rate risk. I mean, it's been in all the newspapers. It's not a surprise that there are institutions that have had unhedged long positions in long duration securities that have lost value as longer term rates have gone up due to our rate increases. So that's not a surprise. I think, as you know, as it is now on the public.
Again, what he's here now saying, "Oh yeah, that's not a surprise." When a couple questions ago, he's like, "Oh yeah, this just happened so fast with SVB." What are you talking about?
Public record, the supervisory team was apparently engaged, very much engaged with the bank, repeatedly, and was escalating. But nonetheless, what happened happened, and so that's really the purpose of one way to think about the review that Vice Chair Barr is conducting, is to try to understand how that happened and try to understand how we can do better and what policies we need to change. I mean, one thing is the speed of I'll come back to that, the speed of the run. It's very different from what we've seen in the past, and it does kind of suggest that there's a need for possible regulatory and supervisory changes, just because supervision and regulation need to keep up with what's happening in the world.
Can you confirm whether or not the board knew about these escalations by the examiners in San Francisco?
I will have to come back to you on that. Yeah,
hey, so if the answer is no, you just say no. If him saying I got to come back to you about that means he's covering for somebody. Oh man, he ran cover, answered, and then look at his head. He just bolted right away. He's like, oh, nope, look, bounce your eyes somewhere else. Look somewhere else. Quickly, someone else ask me another question.
Simon Urbanovich with The Economist. Thank you very much. Chair Powell, you stated twice today that all depositors' savings in the banking system are safe. Are you saying that de facto deposit insurance covers all savings? Shouldn't Congress have a say in that? And just by way of example, if a bank with less than $1 billion in assets failed, are you promising to bail out all of its depositors? Thanks.
They're not, because Janet Yellen said so in a testimony last week.
Well, I'm not saying anything more than I'm saying. So, but what I'm saying is you've seen that we have the tools to protect depositors when there's a threat of
when it's in our interest,
serious harm to the economy or to the financial system, and we're prepared to use those tools. And I think depositors should assume that their deposits are safe.
Go to Greg Robb.
Thank you, Chair Powell. Greg Robb from MarketWatch. I was wondering if you could give us a little bit more color. You gave just a little bit of color. You said during the first week of the Silicon Valley weekend, you said the question you guys asked was, how did this happen when you saw Silicon Valley Bank? So I was wondering if you could go to the Credit Suisse merger. I mean, wasn't that the big gorilla in the room? Didn't you breathe a sigh of relief when that merger happened? Thanks.
What a projected question. Didn't you breathe a sigh of relief when that merger happened? He's like, set him up. Total setup. Here we go.
Sure. So, that was really the Swiss government. We, of course, were following it over the course of the weekend, and we were engaged with their authorities in the way that you would expect, all the ways that you would expect. It seems to have been a positive outcome in the sense that the transaction was agreed to, and it has been, the markets have accepted it, and it seems to have gone well, and I think there was a concern that it might not go well. So.
Here's why it won't go well, because $17 billion of AT1 bonds got written down to zero, literally zero. And that's not just like people who have their private money in the AT1 bonds. It's people that have like their money in PIMCO, and then PIMCO says, hey, here's $1 billion of our clients' money to put in your AT1 fund. Not to mention that the AT1 bonds were created out of the 08-09 financial collapse to be of aid in times like this, and now they got written down to zero. This actually is going to boomerang because it's going to be a big problem. Watch.
Coming into the middle of this week, yes, I would say that has gone well so far.
Nicole.
Hi, thank you, Chair Powell. Nicole Goodkind with CNN Business. In the summary of economic projections, the FOMC sees the unemployment rate increasing to 4.5% this year. I'm wondering how you anticipate preventing this from snowballing while using the admittedly blunt tools at your disposal.
So that's an estimate of what will happen as demand slows and as conditions soften in the labor market. And it's a highly uncertain estimate. And I mean, there's really, we have to bring inflation down to 2%. The costs of bringing it down, there are real costs to bring it down to 2%, but the costs of failing are much higher. And if you read your history, I'm sure you have.
Whoa. The cost of failure is way higher than what they're doing right now, which means, remember he used to say there's going to be some pain. There has to be some pain. And he talked about demand destruction. This is like months and months and months ago. Man, we're going to have to go back and look at some other videos we made about this. But the fact that he's admitting now so openly that the consequence of not doing this is even worse than doing this, that so far, that is the statement of this entire presser.
You can see that if the central bank doesn't get inflation back in place, get inflation, make sure that inflation expectations remain anchored, you can have a long series of years where inflation is high and volatile, and it's hard to invest capital. It's hard for an economy to perform well, and
it's called stagflation. It's where you have unemployment high, you have lack of growth in the economy, and you have interest, or you have costs and inflation through the roof. It's called stagflation. This happened in the 70s here in the United States. Again, he's citing history. Let's talk about that history.
We're looking to avoid that, and and to get back to where we need to be, back to where we were for a quarter century, and get there as quickly as we can.
But I guess the question is, historically, it's hard to.
Mr. Mike, please.
Yes, sir. Historically, it's been hard to contain unemployment, and the question is, do you worry about some sort of snowball effect, and how do you factor that into your projections and your thoughts?
Well, it depends on whether so recessions tend to be nonlinear, and so they're very hard to model.
Okay, I get the question, but here the reality is the reality of it is this: is that the snowball effect has to take place when they increase the cost of borrowing money, and that impacts businesses, and those businesses have to start making cuts. They end up cutting unemployment. That unemployment will mean those people have less money to spend, which means they're going to actually have to rely on other means to spend money or not spend money, which means that's going to create demand destruction, which is less spending on the consumer side. So it is a snowball effect, even though they may want to call it something else. Just by default, it becomes a snowball effect in order to get the outcome that they're hoping to have.
The models all work in a kind of linear way. If you have more of this, you get more of that. But when a recession happens, the reactions tend to be nonlinear, and that's so we don't know whether that'll happen this time. We don't know. If so, we don't know how significant it will be. And so, we're very focused on getting inflation down, because we know in the longer run that is the thing that will most benefit the people we serve. That's how we can have a long. We've had very strong labor markets through these long expansions that we've had. 4 of the 5 longest, or 3 of the 4 longest expansions in U.S. history have been really since the high inflation period. And the reason was inflation wasn't forcing the central bank to come in and stop an incipient or an expansion. You can have very, very long expansions without high inflation, and we had several of those, and they're very good for people. You see late in expansion, you see low unemployment, you see the benefits of wages going to people at the lower end of the wage spectrum. It's just a place that we should try to get back to.
Gene?
That's a great point, and we were there a couple years ago. We're just not there right now.
Hi, Chair Powell. Jean Young with Market News. I just wanted to ask, with all the events of the past 2 weeks, do you still see a possibility of a soft landing for the U.S. economy?
This will be an interesting question. I pause it because I don't want to hear his answer before I say this. He literally just said it'll be a bumpy ride. So first of all, he didn't even say the word soft landing. So she's bringing it up to see if maybe that is something that they have they've taken out of their conversation cycle among the Fed members. That's a great question, actually, because it's kind of pinning up on the corner to say, hey, are you even still talking about a soft landing? Does that language exist in your meetings or not? Because I already heard you a couple minutes ago say bumpy. Let's see.
It's too early to say really whether these events have had much of an effect. It's hard for me to see how they would have helped the possibility, but I guess I would just say it's too early to say whether there really have been changes in that. The question will be how long this period is sustained. The longer it's sustained, then the greater will be the likely declines in.
The greater it's sustained, the harder the landing. Simple as that.
Or tightening in credit standards, credit availability. So we'll just have to see. I do still think, though, that there's a pathway to that. I think that pathway still exists, and we're certainly trying to find it.
Nancy.
Hi, Chair Powell. Nancy Marshall-Genzer with Marketplace. Just wondering how many financial institutions have been issued.
Just a real quick observation. There's a lot of boxed water right there. What's that about? I don't know.
Matters requiring attention or matters requiring immediate attention citations at this point?
How many? I don't know. But those are serious regulatory, particularly immediate attention. That's And I guess there were 6 of them. So
And getting to the seriousness of it, how are you going to ensure that banks comply with these citations, take them seriously? How will you enforce them?
that is a great question and is right in the heart of what the review will be doing under Vice Chair Barr's leadership. So I think that's what you think about. What can we do to make sure that, but again, that's not for me to answer
Do
today.
you have specific thoughts on that?
Well, I see if I did, I wouldn't share them because I really, this review is going on, and I want nothing other than us to find out.
I get it. That's a really good question. I also understand why he can't answer. You got to give Jerome Powell a pass on this one because he can't also say the thing that they're still trying to figure out. Because if you're trying to come up with the context of what variables are worth measuring and which things are actual threats and which ones seem like threats but aren't, if you just go and say all these things right now and then they change in 48 hours or 6 days, 7 days, or 7 weeks or whatever, well, then that just nullifies everything he says right now. So I actually get this one. Jerome, you get a pass.
What happened and why, figure out what we can do to do better, and then implement those changes. That's all I want. It's for me to be giving you my half-formed or partially informed thoughts. It just isn't appropriate. There's a real serious review going on with people from all over the Federal Reserve System who are not connected to this, to this work, not connected to this bank, and under again Vice Chair Barr's leadership, and I'm confident that it will produce a satisfactory result.
Okay, we'll go to Jennifer for the last question.
Ooh,
Thank you, Chair Powell. Jennifer Schonberger with Yahoo Finance. Curious, how do you view financial conditions right now? If credit becomes expensive enough, choking off growth, as you said you're watching for, would that situation warrant a rate cut? What situation would warrant a rate cut? And have the bank failures prompted any discussion around changing the implementation of the balance sheet runoff? Thank you.
So we haven't really talked about changing the balance sheet implementation. That's not something we've discussed yet. As I mentioned, we're always willing to change that if we conclude.
Too early for that. They can't do that yet. There's nothing that they're trying to have, nothing that they're trying to make impactful, meaningful change in is taking foot yet in the way that they need it to. So it's a good question. It's just a little too early.
It's appropriate, but we're really not seeing any signs there. Sorry, then the question before that was, just give me a...
Curious how you view financial conditions now, and if credit
okay.
were to tighten enough, if that would prompt a rate cut.
So financial conditions seem to have tightened, and probably by more than the traditional indexes say, because the traditional indexes are focused a lot on rates and equities, and they don't necessarily capture lending conditions. So we think that, though. So there are other measures which if they're focused on, bank lending conditions and things like that, they show some more tightening. The question for us, though, is how significant will that be, and how, what will be the extent of it, and what will be the duration of it? And then, once you know that, there's a fair amount of research about how that with broad uncertainty bands, how that works its way into the economy over what period of time. And so, so we'll be looking to see the first part of that, like how serious is this, and how does it look like it's going to be sustained? And if it is, it could easily have a significant macroeconomic effect, and we would factor that into our policy decisions. I mentioned with rate cuts, rate cuts are not in our base case, so that's all I have to say. So, thank you very much.
Rate cuts are not in our base case. Woo! That's a statement right there.
Very much.
Wow. Okay. All right. All right. Well, that ended with quite a bang. That is very interesting. Man, I am very curious to see what happens with this, because there was a lot of things that he had said in that meeting right now that are very indicative of how maybe systemically weak he thinks things are, as well as a lot of contrary speak regarding being aware or unaware of how things are going to impact the banks and what was happening. So that is very curious to me that he kind of double speaked. And I know you got to pay special close attention to certain things he's saying in one answer over here and then later over there, and then kind of draw the two together. But that was also very interesting because a couple of times he was talking about how we got to get to the bottom of how this happened and why this happened. It's like, why it happened. Again, if the report that came out a couple days or a week or two ago was that you guys were already had this SVB bank in oversight, then you already should have known some of the things that were going on. And if you knew that they didn't have their risk director in place for months, that you already know is a problem. And then if you already knew, and again, if they were in oversight and you knew that they had a really high disproportionate outlier, he used the word outlier, outsized weighted U.S. Treasury holdings, well, then you knew that too. And then you also know that in the function of holding U.S. Treasuries and increasing Fed funds rate, then you know that that's what's going to happen. You're going to devalue them so bad, so quickly, that it's going to cause them to have to fire sell them at a discount, which just them converting cash, but less than what they bought it for because they were holding it to maturity. Oh, sorry if this is a little technical, but they know all these things. So to hear him say that and then be like, "Oh, I'm not sure why all this happened," but like, you're the guy. You're the guy. You and the group of the Fed members make these policy decisions, and you know the impact of these decisions. And I'm going to go all the way back to saying, okay, if you knew that you have to do rate hikes in order to fight inflation, there's the big three things: get inflation back to 2%, restore price stability to the markets, and bring softening to the labor market, which means have greater unemployment. Well, they're already targeting higher employment. That's fine. They know the domino effect is going to have that impact with higher costs for businesses and higher cost of lending. So like, it's somewhat, as you can tell, frustrating to hear him like admit, yeah, we know these things happen and we know why they work this way and we know how they function. And then in the next sentence be like, yeah, we're not sure what that's going to happen. We're not sure what the outcome's going to be. We don't know. We're going to have to see how that looks before we make another decision and where we go from there and how we go from there and whatever. So, yeah. So anyways, I know there's only a couple of you left on this call. Like, this is helpful to have someone to talk to during this. I'm going to digest some more of this, but did you have a question?
No, I was just saying it was helpful. I think just interesting. I think listening to him about how they, exactly as you say, and not acknowledging that they've caused problems by obviously raising rates as quickly as they have. And it seems to me that they're quite determined to keep going until things are as bad as unemployment and possibly people defaulting on their mortgages. It's just, I don't know, it seems to me that they're quite determined to go in this direction, even though they're beginning to break things. Because if it can't just be SVB that had these treasuries that have lost value, obviously other banks or whatever have got these, as you said earlier, they've not realized these losses yet. And you're saying that they've got capital, but if you're increasing rates, then surely their capital is going to depreciate. So
yeah,
So
absolutely. Absolutely. I mean, it's just one of those, it's so interesting because they know they need to cause demand destruction to slow spending. That's the only thing that's going to make the inflation number is a reflection of money in, money out, like money being spent in the market. So they know that it's a result, not a, like, it's not a leading indicator. It's actually more of a result reflection. And the hard part about the unemployment number is that does lead to less spending, but it leads to less spending in a lot of ways, not just in consumer ways, but like you're talking about with mortgages, it leads to late car payments, late credit card payments. And he didn't bring it up today, but if you've watched any other econ people on YouTube or some other channels, they're talking about how like United States credit card holdings have never been higher. So where we pumped a bunch of money into the economy during the lockdown, and people were able to pay, their savings exploded, and then their credit their credit card balances, they use that money to pay down credit card balances. Well, now you have those credit card balances going back up because people are relying on using their credit cards in order to pay for monthly bills and even such things like groceries and gas. So there's just going to be more wreckage, and that is tough. It's tough because you're also seeing on their dot plot chart that they're forecasting this current experience going through the rest of this year, through 2024 and into 2025. If you saw, their best case scenario, which they have to put forward here, is that they will get to 2% inflation by 2025, which means here we are, March 22 of 2023. What do we got? 21 months left still? I mean, that's just 21 more months before we get to January of 25. So this is going to be very interesting, especially as we can draw comparison to the most recent difficulties we had economically, which was in 08-09.
Yeah, it seems like we're heading into pain territory just for across the world. It'll be interesting to see.
Well, and mortgages and banking had a lot to do with the collapse. I mean, everything to do with the collapse of 08-09. But now they're going to be, so they were kind of like the culprits. Now they're going to be, I'll just say the victims, right? Because they're going to be the ones that are going to be under pain as well, because people are going to stop paying. So it's just a matter of more time happening, more time passing.
Yeah, definitely.
Crazy.
Okay.
So anyways, any other questions or anything else you wanted to chat about while we're still on Zoom?
No, I'm good, thanks. I did find that helpful. I know it's only a couple of people here, but I did find that helpful.
Cool. I'm gonna be over on Discord. I'll post a couple of comments later today, and then we'll see what the market does. Right now, it is taking a nosedive on the equities.
It's a bit of a whipsaw. I think they're trying to adjust.
Yeah.
To try out what doublespeak he was saying there.
Yep.
Yeah.
All right. Well, if you have any other questions, you can post them in Discord. Otherwise, thanks for tuning in, and we'll post more post-recording commentary after this. Thanks, guys.
All right. Thanks. Bye.
Bye.